Hello, everyone. Thanks for joining me. This is Kendi Alvarez. I am a mortgage broker with Collab Lending. I have been originating loans since 2013 and like to take an educator's approach to mortgage lending. My goal is to provide you with the tools that you need to make what is likely the largest financial decision that you will make in your life. Thank you for joining us. And we are going to look at what has been and what will be the cost of waiting to finance your home. I think it's important to look at the trends of the past, but also the projections for the future so that we can help to determine if you should buy now or wait. We all remember and look fondly back on the days when interest rates were at historic lows. A 30-year fixed rate was under 3%, and affordability was great. There were houses on the market, people were buying and refinancing, but the harsh reality is that is not the world in which we live anymore. So, what do things look like compared to the past? Back in the 70s, interest rates were almost 9%. Throughout the 80s, the average was almost 13%. Dropped back down in the 90s to just over 8%. And for most of the 2000s, hovered around 6.25%. And then there were the 2010s where things started to drop significantly. And we were looking at interest rates in the 4s. And then from there, we have the lows of 2018, 19, 20, where we really saw interest rates kind of bottom out. But then now, what's interesting is interest rates currently in 2022 are over 2% higher than they were at the end of 2020. But if you look at the average over time, you'll see that, from the early 2000s to present, we are still significantly lower than where interest rates had been for a large portion of time. Where are things going to go? If we have this magic ball and say, all right, if this is where interest rates are now, where are they going to be? Now, this is data from April of 2022 with the projections of where interest rates will be. And what's interesting is that interest rates currently are even higher than where they are projecting them to be in the future. But this here, we've got Fannie Freddie, Mortgage Bankers Association, and the National Association of Realtors. And they all expect that over the course of 2022 into 2023, we can expect to still see interest rates in and around 5%. Our property values have increased $100,000 on average in the last 2 years. And that means that homeowners that own their homes have gained a significant amount of equity, $50,000 on average in 2020 and $50,000 in 2021. So in the course of 2 years, they've gained $100,000 in equity. What does that mean for home prices currently or home prices in the future? Well, we can expect to see them continue to increase. The real estate industry, on average, expects a 3% year-over-year increase in home values. But for 2022, all of the experts are saying that we're going to be higher than average, if not double, 3 times. And so the average is about 8.7, so let's say 9%. That's 3 times the average for appreciation. So if home prices are going up and interest rates are going up, what does that mean for your affordability of your mortgage? Generally, a lot of first-time home buyers are looking in and around the $100,000 range. So if you're financing $1,000 today at an interest rate of 5.5%, you can expect that your mortgage payment be around $570 a month. If you wait to buy and values appreciate at around that 9%, you're looking at a mortgage of $109,000, an increased interest rate because they're also going up. And so your payment for principal and interest goes up by almost $86. Over the life of your loan, you're talking about $31,000 more that it cost you by waiting to buy. This is about the industry average for homes currently. And so if you're looking at financing around $200,000 at an interest rate of 5.5%, you're looking at $1,140 on average for your principal and interest payment. If you wait for that home to appreciate even more over the course of 2022, you're looking at $218,000. So it's going to cost you more, and then the interest rate's going to go up. So you're looking at $171 per month that your payment increases. That's almost $62,000 more over the life of the loan. Continues to increase as the price of the house goes up. And so if you're looking at $300,000, you're looking at about $260 per month, or almost $93,000 over the life of the loan. At a $400,000 mortgage, you're talking about almost $350 difference in payment, and $123,000 over the life of the loan. How does this impact your purchasing power? This is where things get really interesting. If you can afford a principal and interest payment of $1,700, you would be able to afford a house for $280,000 if interest rates are up at 6.25. Right now, with interest rates around 5%, you're able to afford a home that's $320,000. That's $40,000 in purchasing power that you lose by the interest rate going up by 1.25%. That's pretty significant. If you're looking at a loan amount of $300,000 and we look back into the past, when interest rates were under 3% in January of 2021, the principal and interest payment was $1,200, $1,221.55 to be exact. The projection of where interest rates will be in October of 2022 at around 5.5%, and we're close to that now, that means that your mortgage payment is $1,700. It's not all doom and gloom, although it might seem like it. Homeownership continues to be a hedge against inflation. And what that means is that although inflation is increasing and everyone's worried because compared to 2010, 2020, looking at what inflation was in 2021 and currently, we see inflation rising. But as it increases, we also have significant appreciation in home values. And so you'll see that in 2021, inflation was 6.8%, but home values increased by 18%. What does that mean for homeowners? It means that home ownership remains a solid investment for the creation of generational wealth, and that the net worth of a homeowner is significantly that of a renter. The average homeowner has a $300,000 net worth, as opposed to a renter that only has $8,000. And over time, that continues to grow because the increased equity in your home provides additional wealth. And so looking forward over the next 5 years, it's expected that homeowners will continue to gain equity in their homes by about $100,000. And that's based on the average home price of $360,000. Thank you so much for your time. And please let me know if you have any questions.